Okay, so if you're listening in and you're involved in corporate treasury, you know the fundamental job, right?
Yeah.
Simple. Preserve capital.
Absolutely. Keep it safe. So you end up in T-bills, money market funds, the usual suspects.
The trouble is, when inflation's running hot, those safe havens may be yielding 4%. They actually guarantee you're losing money in real terms. Your capital's degrading.
Yeah, it's that hidden cost of just sitting there, that, 3.8% to maybe 4.8% APY. It feels safe. It provides liquidity, sure, but it's a drag, a silent drag on capital efficiency.
So our mission today in this deep dive is really to unpack this shift. We're seeing Treasury departments moving away from just passively holding cash.
Exactly. Moving towards what we're calling the Active Treasury Model.
And we've pulled together quite a bit here. Research reports, accounting updates, strategies from institutions actually doing this.
Yeah, we want to show you how companies are using digital assets, not for crazy speculation, but to generate significantly better yield, risk-adjusted yield.
Yeah.
And look, the reason this is really taking off now, well, it boils down to a pretty fundamental change in how things are reported financially.
The accounting piece.
Yeah.
That's the why now, isn't it? Because before, under the old FASD rules, well, companies could only recognize losses, right? Impairment losses on digital assets.
Exactly. Bitcoin goes up, you can't book it. It tanks. You got to book that loss straight away. It was, well, it was completely upside down if you're trying to manage capital effectively.
Must have been a nightmare for CFOs trying to give a clear picture.
Oh, absolutely. So the breakthrough is this new FASB standard. It now requires companies to measure certain crypto assets at fair value. Meaning they recognize both gains and losses on their income statement every quarter. It just provides a much more transparent, realistic financial picture.
And that removes that massive historical barrier, the thing that kept so many corporate treasuries just watching from the sideline.
Precisely. And it's not just accounting. We're also seeing, regulatory clarity starting to emerge globally.
Like the MiCA framework in the EU.
Yeah, things like MiCA or even the Genius Act discussions in the US. They're replacing that old ambiguity with clearer rules of the road.
Which helps legitimize things like stablecoins as, reliable cash equivalents.
Okay, so let's walk through the strategies. The first one that really emerged, Strategy 1, we call it the digital gold approach.
Right, this was the foundational move. Kicked off around 2020, give or take. The idea was pretty simple. Use Bitcoin, BTC, as a passive long-term hedge.
Yeah, companies saw it as, digitally scarce, verifiable, a potential shield against growing government deficits, currency losing value, inflation worries.
You had pioneers like MicroStrategy making it their main reserve asset. Block Inc., formerly Square, did something similar.
A pure store of value play.
Yeah.
But our sources really point out a key difference between that first wave and what's happening now. And it's all about the financing.
Yeah. That early phase, there was some structural fragility there, wasn't there?
Definitely. A lot of those early adopters, they relied heavily on convertible debt, on leverage, to actually buy their Bitcoin.
Which means if the market turned sharply against them, they were looking at potential default risk, debt coming due they couldn't easily handle.
Exactly. That debt maturity overhang was a real risk. The newer strategies we're seeing, fundamentally different in how they're funded, much less reliant on that kind of leverage.
Okay, so that brings us nicely to strategy 2. The active yield play. Using DeFi, decentralized finance, my big question here is, how do you take corporate cash, which needs stability above all else, and safely get it into this, let's face it, pretty complex ecosystem? And where does that better yield actually come from?
Right, and that's the absolute core of this active treasury idea. You're not jumping in with volatile assets straight away. You use stablecoins. Think USDC.
Okay, the dollar peg coins.
Exactly. Regulated top-tier ones, backed one-to-one by actual cash and short-term T-bills, held separately. They give you that rock-solid stability of the US dollar, but with the, the tech advantages, 24/7 programmability, speed of a digital asset.
Okay, so step 1, digitize the cash into a stable form. Got it. Now, how does that stablecoin suddenly earn, say, 8% when a T-bill is stuck at 4.5%? Is it just hidden leverage or speculation somewhere?
No, and this is really the crucial bit to understand. It's not speculation, it's more like automated commerce. You take those stable coins and deposit them into what's called a liquidity pool.
Liquidity pool. Okay, what is that in simple terms?
Think of it like an automated, decentralized currency exchange. By putting your stable coins in, the corporate treasury becomes a liquidity provider and LP. You're basically supplying the inventory, the digital cash that this automated marketplace needs to function.
So you're kind of like the house in the casino, providing the chips for the game.
That's a decent analogy, yeah. You're providing the essential liquidity. And in return for that service, you earn a slice, a proportional share, of all the transaction fees, the trading commissions that get generated every time someone swaps currencies within that pool.
Ah, so the revenue comes from actual economic activity, from trading volume, not from betting on prices going up or down.
Precisely. Real consistent activity.
That really changes the game for potential returns.
Yeah.
If your traditional money market fund is giving you, say, 4.5%, what can a conservative active treasury strategy realistically aim for?
Conservatively, yeah. If you stick purely to what we call Tier 1 pools lowest risk, stablecoin-only pairs, like pooling USDC with another big stablecoin like USDT, the yields typically run between 5.0% and 8.0% APY.
Okay, already better. What about moving slightly up the risk curve?
If a treasury gets comfortable and moves to a Tier 2 strategy, maybe pairing a stablecoin with a well-established blue-chip crypto asset, well, then the potential returns jump quite a bit. You could be looking at 8.0% to 15.0% plus.
Wow. I mean, just think about the pressure that puts on a traditional treasury manager right now. That shift, let's put numbers on it, a $500,000 allocation that gets you $22,500 traditionally,
Yeah.
could suddenly be generating anywhere from $36,000 to $54,000 using a conservative to moderate active treasury strategy.
That's a 60% to 140% jump in yield. It's significant.
Right.
And that potential for much higher yield, well, it naturally leads companies to explore strategy 3. This moves beyond Bitcoin's sort of passive digital gold role.
And looks at Ethereum, ETH, as a productive asset.
Exactly, the ETH contrast. Because Ethereum shifted to proof of stake, holding ETH isn't just holding a potential store of value anymore. It's holding an asset that can actively generate its own yield through staking.
Right, so companies lock up their ETH, help run the network, keep it secure.
And in return, they earn native rewards, paid in ETH.
We're seeing companies actually do this.
Oh yeah, there are clear examples. Companies like SharpLink Gaming, they're staking 100% of their ETH reserves to capture that native yield. Bit Digital reported something like 3.2% APY from staking just this year.
And crucially, how are they funding these ETH positions? Is it the same old debt story?
No, and that's the important divergence from those early BTC plays. The second wave companies like SharpLink, BitMine, GameSquare, they've largely funded their positions through equity issuance.
Ah, so they learned the lesson. Avoided that debt overhang, that default risk tied to the heavy leverage the early BTC pioneers used.
Exactly. It's a much more structurally sound approach.
And some are getting quite sophisticated now, aren't they? I saw GameSquare mention plans to go beyond simple staking.
Yeah, they're looking at enhanced risk-adjusted yields using more complex DeFi strategies on top of their ETH holdings. They're publicly targeting returns in that 8% to 14% range.
Okay, let's shift gears slightly to what feels like maybe the strongest bridge between, traditional finance and this new digital world. Tokenized Real World Assets, RWAs.
Yeah, RWAs, it's a simple concept, really. You take real-world stuff, government bonds, corporate debt, maybe even securities, and you represent ownership of them as a digital token on a blockchain.
And this is gaining traction.
Big time. The market for tokenized RWAs surged recently, something like 260%. And look, when you have Larry Fink, the CEO of BlackRock, calling tokenization the next generation for markets, well, that's about as mainstream an endorsement as you can get.
Okay, but why should a corporate treasurer care if their T-bill is on a blockchain versus sitting in a traditional account? Is the yield better?
Not necessarily the underlying yield itself. Tokenized U.S. treasuries, for instance, they're yielding around 4.1% yield to maturity right now, which is, pretty much in line with the traditional ones. The real advantage, the competitive edge, is 247 liquidity and instant settlement.
Ah, okay, so traditional markets close, right? Weekends, holidays, overnight.
Exactly. There are market hours. There's settlement friction, T+1, T+2 delays. Blockchain markets, they run constantly, 247, 365. Transactions settle almost instantly.
Which eliminates settlement risk and allows for continuous, immediate compounding, potentially boosting efficiency.
That's the core value proposition. It's not necessarily higher base yield on the asset itself. It's the elimination of all that traditional market friction. It's about round-the-clock capital efficiency.
Makes sense. And how does regulation work here? Is it a whole new regulatory world?
Actually, it's surprisingly straightforward. The principle is the rules that govern the token are determined by the underlying asset it represents.
So if the token represents a security,
then SEC rules apply, just like the traditional version. If it represents a commodity or it's used in a derivatives contract, then the CFTC likely has jurisdiction. The blockchain tech doesn't change the fundamental regulatory nature of the investment itself.
This all sounds like a pretty massive transformation, honestly. But with big shifts always come complexity and risk. If a treasurer is looking at moving toward an active treasury model, what are the absolute critical risk layers they need to manage? Beyond the standard financial risks, I mean.
Yeah, risk management has to be incredibly robust. And, the crypto winter of 2022 really hammered home that often it's human behavior risks like poor governance, bad decisions that cause more damage than the tech itself failing. But focusing on the tech and operational side, there are maybe 4 key layers. First up, smart contract risk.
Okay, that sounds like the risk of a bug, right? A vulnerability in the actual code that controls the funds in these DeFi protocols, which could lead to, well, disaster. How do you possibly mitigate that?
Mitigation here demands really strict standards. You absolutely must rely exclusively on what we call blue chip protocols. These are the ones with long proven track records, multiple independent security audits from reputable firms, and this is crucial high TVL.
TVL, total value locked.
Exactly. That's the total dollar value of all the assets currently deposited and locked within that protocol. A high TVL, billions of dollars, acts as a strong indicator of user trust and, frankly, means it's been battle tested. Hackers have likely tried and failed.
Okay, so stick with the big, proven, heavily audited protocols with lots of money already in them. Got it. What about just the sheer price swings? Market volatility.
Right, that's market risk. And specifically within DeFi liquidity pools, there's a unique type called impermanent loss.
Impermanent loss. Sounds ominous.
It happens when the prices of the 2 assets you've paired in a pool start to diverge significantly. So imagine you're providing liquidity with USDC, the stablecoin, and maybe a more volatile token like, say, AVX. If AVX's price shoots up or crashes relative to USDC.
Your position in the pool doesn't capture all that upside, or it amplifies the downside compared to just holding the assets separately.
That's basically it. Yeah, you can end up with less overall value than if you just held the 2 assets outside the pool. It's complex to track and manage.
So how does a corporate treasury dip its toes in without getting immediately burned by that kind of volatility risk?
You start super conservatively. The initial pilot, the first phase, must focus purely on stablecoin-only pairs, like USDC paired with USDT.
Because their prices are basically pegged one-to-one.
Exactly. That effectively eliminates impermanent loss or minimizes it dramatically. You deal with the operational side first, get comfortable, then consider pools with more volatility if appropriate for your risk appetite.
Okay, makes sense. Then there's the simple but maybe the most terrifying risk. Just losing the keys?
Custodial risk.
Yeah, losing the private keys that control the assets. For any corporate treasury, the policy here has to be absolutely non-negotiable. Zero self-custody, period.
Meaning no internal employee holds the keys on a company laptop or anything like that?
Absolutely not. Assets must be held with qualified, insured, institutional-grade custodians. Think Fireblocks, Coinbase Prime, firms that specialize in this.
And they offer things like multi-sig?
Multi-user approval workflows, exactly. So no single person can move funds. It requires multiple sign-offs, reducing the risk of internal fraud or simple error catastrophically.
Right. And the last one, the moving target.
Yeah.
Regulatory and compliance risk. Always a factor in a new space. This just demands having dedicated specialized legal counsel who really understand digital assets. The initial strategy should focus on assets where the legal status is clearest. Payment, stablecoins are generally a good starting point.
And just maintaining constant vigilance and getting ongoing advice as the rules evolve globally.
You have to. It's part of the cost of operating in this space responsibly.
So let's wrap this up. What's the big takeaway for you listening in? We've journeyed from, just passively holding cash that's losing value to inflation.
Through that first wave of Bitcoin as a sort of passive digital gold hedge.
Into this much more sophisticated active treasury model. Using DeFi, using stablecoins, even tokenizing traditional assets like T-bills.
Yeah, the whole narrative, it's fundamentally shifted. It's moved away from just being a speculative bet towards being a productive yield-generating strategy.
And you've got the big institutions, BlackRock, Fidelity, seriously involved now. Plus, crucially, those clearer accounting standards from FASB. It's professionalizing the whole space.
The active treasury. It's not some fringe idea anymore. It's rapidly becoming a new benchmark, a new expectation maybe for capital efficiency.
Which leaves us with, I think, a really provocative final thought for you to chew on. If this active treasury model offers things like 24/7 liquidity, instant settlement, better compounding, can traditional financial instruments like the plain old money market fund actually survive the next decade without tokenizing themselves, without adopting the same kind of underlying blockchain infrastructure.
It flips the script, doesn't it? It's maybe no longer just about how quickly companies adopt digital assets. The bigger question might become how quickly traditional finance has to evolve just to offer the same speed, the same efficiency that blockchain technology is now providing as potentially the new baseline expectation.